Hey everyone, welcome back to Conviction Bet. Hope you're doing well. It has been a strange week to be staring at a screen. The market's been sitting up near record highs. And then the new Fed chair, Kevin Warsh, wrapped up his very first meeting and made it pretty clear that the next move on interest rates might be a hike, not the cut everyone spent the spring hoping for. Inflation's back above 4%, an energy shock doing most of the work. The AI trade is still dragging the whole index around by the collar, and everybody is a little jumpy. And speaking of things that probably should have rattled the tape more than they did, this week a rocket company bought an AI coding startup for $60 billion and for a moment became worth more than Amazon. And honestly, that wasn't even the strange part. The strange part is what's standing in line behind it. A whole pipeline of AI and tech companies with private market valuations now running into the trillions, much of it companies that don't yet make a dime. Dryly. Somewhere inside that number is a question nobody at the party really wants to ask out loud. But here's what actually matters this week. $75 billion raised at the offering. $85.7 billion after the green shoe. The largest public offering in the history of markets. A valuation that within days traded above $2 trillion. And on paper, the first trillionaire the world has ever produced. SpaceX went public, and for a few days, it was worth more than Amazon. The market is telling a story about the AI boom minting the richest people who have ever lived. The real story is about something much older and much less glamorous. When the check for all of this finally lands on the table, and it will, who actually pays it? I'm J.L. Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. I'm going to make the case that the single most important question in the entire AI build-out is not whether the technology is real, it is, but who ends up holding the bill. And I'm going to argue that the people quietly writing that check are shifting right now from the richest companies on earth to the bond market and the private credit funds, which is a very different thing. By the end, I'll show you the one number that decides whether this whole episode rhymes with the railroads or with the dot-com fiber bust. And it is not a number any company can put on a slide. Start with why this keeps happening, because the stakes are the whole point. For about 150 years, the great fortunes have been minted the same way, by whoever owned the newest layer of infrastructure. And the layers arrive in a predictable order. First, transport. The railroads stitched a continent of isolated little markets into one national, one making railroad fortunes like Vanderbilt's and pulling the steel fortunes like Carnegie's along with them. Then energy. Rockefeller's Standard Oil, which at its peak was worth an estimated 2% of the entire American economy and the electricity that came after it. Then information. The internet, which made Gates and Bezos and the rest. Every one of those waves did the same two things. It redefined what was scarce, and it reshuffled who was rich. And here's what's striking about SpaceX going public as the largest offering in history. It is the first company to bundle all three of those networks into a single ticker launch and transport, a satellite network beaming the internet down from orbit, and the compute and power ambitions stacked on top of both. 3 fortune-making networks, 1 listing. No wonder it produced the first trillionaire. And the reshuffle is concentrating, not spreading out. By the economist Gabriel Zucman's estimates, the richest 1/100th of 1% of American families hold around a tenth of the nation's wealth, higher than that same sliver held back in 1913 at the peak of the first Gilded Age. We are back to Gilded Age levels of concentration, and the AI boom is pouring fuel on it. So the stakes here are not abstract. Every one of these buildouts decides who ends up rich and who gets left behind. And that's exactly why the boring sounding question, the one about who actually pays for all of it, is the one worth obsessing over. Let me start with a lens, because once you have it, everything after it clicks into place. Picture the most expensive dinner ever ordered. An enormous table. The finest of everything, bottles nobody bothered to check the price on, courses still arriving, everyone is having the time of their lives. And the entire mood of that table depends on one quiet fact that hasn't come up yet: who is going to settle the check when it arrives? Because there are two very different versions of how that night ends. In one, everyone paid their own way as they went, and the bill is just a formality. In the other, one person got talked into putting the whole thing on their card on the promise that everyone would pay them back later. Same dinner, completely different morning after. That is the question I want you to carry through this whole episode. In any giant build out, somebody eventually has to settle the check to pay in real cash for infrastructure that got built ahead of the demand. And here's the part most people miss. The value in any business chain doesn't flow to whoever is busiest. It flows to whoever gets to keep the money once the rush is over. Flow is not wealth. Retained flow is wealth. Think about the toll booth. The cars are the flow. But the person who gets rich isn't the one who built the road and moved on. It's the one sitting in the booth collecting a little something from every car for years. You can carry enormous volume and keep almost none of it. Look at the suppliers who assemble the world's smartphones. They book staggering revenue, billions of units, and they retain razor-thin margins because they raised the capital, built the capacity, and then sold into one giant buyer who priced them right back down. The brand at the top sat in the toll booth. The suppliers paved the road. And when the demand doesn't show up the way everyone assumed it would, you find out exactly who was holding the check. The cleanest example is the dot-com era. Telecom companies laid something like 80 million miles of fiber optic cable, dead certain that internet demand was bottomless. After the crash, the overwhelming majority of it sat unused for years. The industry literally called it dark fiber. And a lot of that build had been propped up by something called vendor financing. The equipment makers, Lucent and Nortel and Cisco, lending their own customers the money to buy their own gear, which made demand look real, right up until the customers couldn't pay. When the end customer never showed up to settle, the lenders settled instead. The fiber was real. It's still down there, carrying your video calls right now, but the first generation of money that paid for it was mostly vaporized. And this pattern is older than fiber. The historian Richard White wrote a whole book showing that America's transcontinental railroads got built on a foundation of bankruptcies and back-to-back depressions. The network endured for a century. The people who funded it mostly did not. So here is the so what, and it's the most useful habit I can give you as an investor. In any build out this big, don't ask who is booking the most revenue. Ask who actually banks the cash when the music stops. That one question would have saved you in 1999, and it's the question that matters most right now. Now, let's talk about who's settling the check this time. For the moment, the bill is being paid by the hyperscalers, the handful of cloud giants building all of this, and give them their due. They can afford it. The four biggest generated an estimated $203 billion in free cash flow last year. That is the bull case in a single number. This is not a band of speculative promoters with no money. This is being built by some of the strongest balance sheets in the history of business. The Big Five are on track to spend more than $600 billion in capital expenditure this year alone. By some Wall Street estimates, closer to 700, up about 36%, with roughly 3/4 of it pointed straight at AI. For now, much of that is still coming out of pocket. But here's the tell. The marginal dollar, the next dollar of spending, is increasingly borrowed. In 2025, these companies issued about $121 billion of bonds. That's more than 4 times their average over the previous 5 years. Meta financed one of its giant campuses through a roughly $27 billion private credit deal with an investment firm called Blue Owl, and here's the structure that matters. Meta only owns 20% of it, with most of the financing sitting outside its own corporate debt. It was the largest private capital deal on record. Oracle, the most stretched of the group, is already carrying net debt above 3.5 times its earnings. And the cost of insuring some of these companies' debt against default has quietly started ticking up. Now, a growing share of these obligations never shows up as debt at all. The Bank for International Settlements, which is about as sober an establishment as finance gets, looked at these arrangements and gave them a name. They called it shadow borrowing. Obligations that behave exactly like debt, funded by private credit funds and insurance companies, but parked just off the corporate books. Moody's added up the not yet started lease commitments across the 5 biggest names and got to $662 billion, equal to about 113% of their reported debt. The check, in other words, is increasingly being written by the bond market and the private credit world, not by cash in the till. And then there's the part that should make anyone who lived through 1999 sit up straight: the circular financing. Remember Lucent and Nortel lending customers the money to buy their gear? Watch this. NVIDIA announced plans to invest as much as $100 billion in OpenAI, which is conveniently its own largest customer. By early this year, NVIDIA's own CEO was calling that pledge non-binding, and in his words, never a commitment. Now, NVIDIA did put a real $30 billion into OpenAI's latest funding round, but Jensen Huang himself suggested it might be the last before OpenAI goes public. Meanwhile, the chipmaker AMD handed both OpenAI and Meta separate warrants, each one for up to 160 million shares, roughly 10% of the company apiece, in exchange for buying its chips. Money is circling a very small group of players, and every lap of the track books revenue or backlog or a commitment off the very same underlying spending. It's an elephant balanced on an ant, a $1 trillion tower of market value resting on a thin little base of customers who are actually today paying real money for the product. OpenAI, for its part, is projected to lose around $14 billion this year. So the so what here is a shift in where you point your attention. As long as this was funded by free cash flow, the risk lived on the income statement. Can they earn enough? Now that the marginal dollar is borrowed and increasingly hidden off the books, the risk has migrated to the balance sheet and to the people who hold that paper. That's where the next crack, if there is one, shows up first. Now, here's where it gets uncomfortable. Because all of this money is funneling into a smaller and smaller number of places. The Magnificent Seven now make up about 35% of the entire S&P 500 by market value. Across last year, they carried a weight closer to 33%, but drove roughly 42% of the index's total return. And by Russell Investments math, the 10 largest companies generate nearly 70% of the profit the whole index earns above its cost of capital. There's even a name going around for it: the profit gap. In the fourth quarter of last year, those 7 companies grew earnings around 20%. The other 493 grew them about 4%. When you buy the market today, you are not making a broad bet on the American economy. You are making a concentrated bet on 7 balance sheets, and about 35 cents of every passive dollar rides on them. And here's a wrinkle that makes the spending even harder to outrun. You'd think AI gets cheaper, and it does. The price of a given amount of computing has been falling by something like 10 times a year. But cheaper hasn't lowered the bill, it's raised it. Because the moment compute gets cheap, people stop using it for one quick question and start running it constantly. Agents that think in the background all day, burning tokens the whole time. Falling unit costs and exploding total costs turn out to be the same coin. The check just keeps getting bigger. And there's a second misconception worth killing, because it tells you where the real toll booth is. The binding constraint on AI is no longer only chips. Increasingly, it's power, grid connections, cooling, the sheer speed at which you can physically stand up a building and plug it in. Microsoft has spent the last several quarters openly warning that demand for AI compute is outrunning how fast it can build and energize data centers. They call it a capacity crunch. Remember the toll booth? When the bottleneck is the substation and not the silicon, the node that keeps the money is the one selling electrons in grid access, not the one renting out a model that a bigger lab can copy by Thursday. Now, underneath all of this, AI is doing something to the rest of us that I think is widely misunderstood. Here's the thing you need to understand about these models. An AI is, at its core, an averaging machine. It's trained toward the cleaned up middle of everything it has ever read, and it hands that competent average to anyone who asks instantly for almost nothing. So it does 2 things at once. It raises the floor and it widens the ceiling. 80 out of 100, the competent, unremarkable, good enough baseline that just became free for everyone. Which means 80 no longer commands a premium. The scarce thing is no longer competence. It's the judgment to know which question to ask and which answer to keep. And there's a deeper version of this that's worth sitting with, because it tells you exactly where the human edge survives. A model is trained to fit the world as it already is, the whole existing distribution of everything that has ever been written down, which makes it extraordinarily good at handing back the consensus of what's already known and much less reliable out at the edges, where the genuinely new thing hasn't been written down cleanly yet. What's out there tends to look to it like noise to be smoothed away. Think about how real discovery actually works. For a very long time, everyone assumed the planets moved in perfect circles, and the data almost fit off by a tiny smudge about 8 arc minutes. A lazy mind rounds that away as noise. Kepler stared at the smudge until it broke the circle, and that's how we got the elliptical orbit. That is the move a statistical average is least equipped to make. It will hand you instantly and for free the consensus of everything already known. It's far weaker out where the thing nobody has clean data for yet is still hiding. And that's not just a line about careers, it's a direct instruction for investors. The floor on having a view has collapsed because everyone is now querying the same models and getting back the same plausible sounding paragraph. So the edge moves to exactly the things the averaging machine can't reproduce: proprietary information it was never trained on, the unglamorous physical asset, the contrarian read that lives out in the tails. It's built to smooth away. You can already see the human cost of this. And here's the cruel part. The first people hit are the ones building the thing. Stanford's Digital Economy Lab found that employment for software developers aged 22 to 25 fell nearly 20% from its late 2022 peak, while workers over 30 in the very same field kept growing. Salesforce paused junior engineering hiring. Amazon cut about 14,000 corporate roles. The entry rung is being automated first. So the so what is blunt. A rising floor is not a growing pie. Own the nodes that retain the flow, the scarce physical inputs everyone has to buy no matter which model wins, and the rare core pieces of the stack that bank cash instead of plowing it straight back into the next spending cycle. Because a supplier that earns a fortune and then immediately spends all of it on the next round of capacity is retaining nothing. Its value rides a roller coaster way up in the boom and straight back down the moment the orders pause. And treat the thin edges, the model wrappers, the Me Too apps sitting 1 inch from a frontier lab that can swallow them overnight as a trade, not a position. Which brings us to the question this whole thing actually turns on. Is the pie even growing? Because the railroad grew the pie, so did electricity, so did the internet. Each one expanded what the whole economy could produce. Does AI? And the honest answer is we don't know yet, and the evidence points in 2 directions at the same time. Here's the bull case, and it's real. At the level where actual work happens, the gains are measurable. A Harvard and BCG study found consultants using a frontier model did about 12% more tasks, a quarter faster, at meaningfully higher quality. Although, in this matters, that same study found the effect flipped on problems outside the model's competence, where the AI users were noticeably more likely to confidently get it wrong. The gains hold only where the human already knows the edge of the map. A Stanford and MIT study of customer support agents found a 14% productivity lift, biggest for the least experienced workers. And U.S. productivity grew about 2.7% last year, nearly double the prior decade, which the economist Eric Brynjolfsson attributes in part to AI. Goldman Sachs thinks this could add 1.5 percentage points to annual productivity growth over a decade. And I know what the bear case is. It's 1987, almost word for word. That year, the economist Robert Solow looked around and said, you could see the computer age everywhere except in the productivity statistics. The gains didn't actually show up until the mid-1990s, about 15 years later, once companies had completely redesigned themselves around what the machines made possible. The lag wasn't the technology. It was the slow human work of reorganizing around it. Torsten Slock over at Apollo has updated the line for our moment. AI, he says, is everywhere except in the incoming macroeconomic data. A survey this February from the National Bureau of Economic Research, nearly 6,000 executives across the US, the UK, Germany, And Australia found the vast majority reported no measurable productivity gain at all. The economist Daron Acemoglu models the whole effect at well under 1% over a decade. In his word, disappointing. And US productivity growth actually slowed again in the first quarter of this year. That is a legitimate, serious concern. There's a deeper lesson buried in that bear case, and a version of it just won a Nobel Prize. The 2025 Nobel in Economics went in part to the theory of creative destruction, the idea that new things relentlessly kill off old things, and just as importantly, to the historian Joel Mokyr, whose work is a reminder that technology only compounds where the institutions and the culture actually let it spread. And here's the uncomfortable part of that theory for an investor. The losers are rarely the obvious ones. They're the incumbents who spend the most trying not to be left behind, the old champion, making the single biggest bet to survive the new era, which is exactly the bet that leaves it most exposed when the thing it's chasing turns out to wear out in 3 years. The most dangerous seat at the table is sometimes the one that looks the safest. So let me be fair to the bulls before I land this. Today's giants are genuinely different from the telecom companies of 2000. They're profitable, they throw off cash, they fund most of this from operations, and even the circular deals are structured to pay out against milestones rather than handed over up front. So for the cash-generative incumbents, this is far more a question of return on incremental capital than of going broke. Carefully, the risk isn't that the building collapses tomorrow. It's quieter than that. Here's the part that ties it all together. The danger lives in a timing mismatch. The bill comes due on a fixed schedule, bond maturities, lease payments, all with dates on them. The productivity gains, if they come, arrive on an uncertain one, measured in years of slow organizational redesign. And there's a clock the railroads never had. Rail was century-long infrastructure. The compute hardware inside an AI data center wears out in roughly 4 to 6 years, even if the building and the power around it last longer. Which means much of the debt has to be repaid before the asset that justified it is even obsolete. And here's the number I promise you. For all the talk that this is the largest build-out in a century, it isn't quite. Depending on whose comparison you use, AI investment is running somewhere around 1 to 1.5% of GDP, smaller than the biggest infrastructure booms in history, the railroads and electrification among them. Smaller than the myth, but on a far shorter fuse. And JP Morgan ran the math on what it would take to make the whole thing pay. To earn a 10% return on its modeled AI investments through 2030, the sector would need about $650 billion in brand new annual revenue every year into perpetuity. And notice the flip side of that dark fiber story, because it's where the patient money actually lives. When the first generation of capital gets wiped out, the infrastructure doesn't vanish. It gets bought cheaply by whoever has the cash and the patience to wait. The fiber that bankrupted the telecoms became the dirt cheap backbone that the next generation of internet companies ran on for pennies. So even in the bearish version of this, the right question is not, does it blow up? It's who is standing there with dry powder when it does. The asset stays real. The ownership just changes hands, usually from the impatient to the patient. So bring it all the way back to that dinner table. The food is real. The kitchen is extraordinary. Nobody at this point seriously doubts the meal was worth cooking. The only question left is who's holding the card when the check arrives. If real demand shows up in time, if customers pay in cash for what got built, then the customer settles the check. In 2026 looks in hindsight like 1888, painful in spots, transformational in total. But if it doesn't arrive fast enough, financial capital settles instead the bondholders, the private credit funds, the insurers holding that shadow borrowing paper, and the index investor who never realized he was holding 35 cents of every dollar in 7 names. The infrastructure would still be real. It would still be useful. It's the first generation of money that wouldn't survive. And here's the deepest reason I stay humble about all of this. The market itself is a kind of intelligence, not a predictive one, a collective one. Millions of people acting, getting feedback, adapting the way an ant colony solves problems. No single ant could even understand. An AI model is the opposite kind of intelligence. It is a brilliant prediction of the past, and it's superb right up until the environment changes. The market's entire job is to price the change the model can't see yet. So when everyone is pointing the same models at the same data and getting back the same answer, the thing actually shifting under their feet, a new Fed regime, a credit cycle turning, is exactly the kind of break a backward-looking average is built to miss. So here's specifically what I'm watching. Not the CapEx headlines, not the next trillion-dollar valuation. 3 things. 1, whether the marginal dollar of spending is still cash, or whether more of it every quarter is bonds and private credit. 2, whether those off-balance sheet structures, the shadow borrowing, keep growing faster than the profits underneath them. And 3, the one that actually settles it, whether real downstream revenue, customers paying cash for AI products, starts showing up at the scale the spending already assumes, because that is the one thing no company can put on a slide, whether the customer starts settling the check before the bond market does. That's the whole game. AI will redistribute wealth as surely as the railroad did. Whether it grows the pie or just quietly reshuffles who's holding the bill, that depends entirely on who turns out to be sitting at the table when the check comes. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's quietvelocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts: Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.